can do that by clicking the plus button here. All the charts I have are the Maxi futures chart. So what you can do is if you click the plus button here and then you go to crypto, you can choose all sources. You can type in Maxi, and you can also choose swap. So if you use these two, it'll make you only come up the Maxi apps. So you only see the spot, in this case the futures contracts pairs of Maxi. So that makes it a little bit easier to add them, because if I now search for let's say Ripple XRP, I will only see the USDT and the USD futures contract on Maxi, and if I didn't, you get a long list, and you will have to be searching for Maxi or the one you want. Usually if I trade futures on Maxi, I would want to have the chart, the futures chart from Maxi here, because of little price differences between exchanges. Yeah, you have two types of trading, or three types. You have the scalp trades, which are basically trades, in and out trades. So as we see here on your screen, this is the Bitcoin weekly chart. So if you would do a technical analysis on this, and you would try to trade a setup on this chart, it would probably take months, maybe a year to play out. Let's say if you look at the last bull run, this was the last bull run, started here, so that was the blow off top. So let's, if you look at this space, you should, let's do some TA on it. You could say, well, this was, in hindsight, it was a double top, and let's say you shorted the double top, and you would you would say, okay, this area would have been my take profit. As you can see, where is the measurement? Date range. So we're talking about, in this case, half a year, 182 days. So that's a weekly chart, but we tend to usually trade on the 1 hour, the 1 hour or the 4 hour chart. So the higher the time frame, the longer you expect it to take to play out, because if you look at technical analysis, you always look for patterns, or I do look for patterns, and then you look for a move back to lows or back to highs, for example. Then if every bar is 4 hours, this move can take a lot longer than every bar is just 1 minute, because TA on the 1 minute time frame stays the same, only it's zoomed in and it goes quicker. So like I said, depending on the time frame, but if you go into a swing trade, which is usually when you look for a daily time frame, you can expect it to take weeks, maybe even months to play out, because you disregard the lower time frame, how do you say it, low time frame price action. So if you scalp on the 1 minute or you scalp on the 5 minute, then you disregard the higher time frame, although it can help to know where some resistance areas are if you're scalping. But I do say this again and again, scalping is really a pro skill. You have to develop skills to be a good scalper. I think a lot of pro traders, even pro traders, aren't that good scalping because it's just you have to have skills to be a good scalper. So when starting out, I advise people always to start on higher time frames. So use the 1 hour to 4 hours, and use higher time frames for confirmation of trades, because sometimes on a lower time frame you can have a great setup, like this Bitcoin hourly. Let's see, I draw a trend line. Let's say I have this trend line on, and I want to know if there is a breakout. Do I have room to move up? Then it's always good to check maybe the daily or the 4 hour time frame to see if there is any resistance. As you can see here, there is a big support and resistance area here. Price traded along in this area, so definitely a breakout here wouldn't say we would see some more upside. So yeah, FVGs and being red or green, in this case, if you see here on the chart being black and white, I like that. It's easier on my eyes. What I see in FVG here, fair value gap, for the people that don't know, fair value gap is a place where price hasn't in a downtrend or an uptrend, a moment in price where price didn't trade, so it just fell through. As you can see, mostly on pumps and dumps, you can see fair value gaps, and the consensus is that 90% of the time the fair value gap gets filled. So a lot of times, eventually, price will move back to a fair value gap. And the question Crypto asked was, does the 3 candles of a fair value gap, because a fair value gap consists always of 3 candles, where the first and the third candle their wicks don't overlap each other. So as you can see here, if I zoom in, we have one bearish candle, a second bearish candle, and a third bearish candle, and you see the wick from the third candle left a gap between the third and the first candle wick. So that means here's a fair value gap, and to answer your question, it doesn't always have to be red, or bearish, or bullish, but the consensus is that that's if that is the case, it's a stronger fair value gap. As you can see here was also a fair value gap. Started with a bearish candle, bullish candle. So, but this is still considered, when TAing, this is still considered a fair value gap. And what does a fair value gap, where is it used for? Like I said, most of the times you'll see price eventually get back into the fair value gap to fill it, or at least to get to the 0.5 of the FVG. You can use the fair value gap in trading in your strategy as confluence, but never trade it alone. because when trading you always look for more than one indicator or more than one thing on the chart telling you that you are looking at a good spot to enter a trade. So you could say this area could be a good spot for a short because there is a fair value gap that could be filled. But what you then do is that you have to look at confluences. So should there be EMAs? Is there any other support and resistance in this area? Is there a trend line? Is there a golden pocket Fibonacci extension in this case, because we had a down move? So you can see if I draw fib retracement from the highest high to the lowest low, and I make it golden pocket, you'll see that the golden pocket is above that FVG. But if you could look good enough, there's also a fair value gap formed here. So this one. Also a fair value gap. So as you can see, I really never look at those candles. Bearish, 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 bullish, bullish, bullish. But to be a textbook FVG, consider it to be 3 of the same color candles. Yeah, also that's what it is with trading. Eventually you just have to find and look for the things that fit your strategy best. And also with golden pocket, you can find a lot of info on that, and you can find a lot of different views on that. Let's for a moment clear the FVGs and make the Fibonacci a bit clearer. So we want all those golden pocket. As you can see, the golden pocket I use is between 618 and 65. Sometimes you see 618 and 66, but that's the most commonly used. You also see people saying, well, it's between the 0.5 and the 786. Well, that's a big golden pocket. So that makes, in my opinion, it doesn't make it a good indicator if you say, well, between 0.5 and 786, that should be a good area for some confluence, because that's a lot of room to move. So in my opinion and in my experience, the 618 to the 65 works best, but that's for me. There's probably some others traders who think, well, for me it works better if I put the 618 and the 7. But the most commonly used are 618, 65. But anything, it ranges between the 0.5 and the 786. For beginners, I think, well, that's personal, but that's because I like to trade let's call it the BOBD, the breakout breakdown strategy. I did a YouTube video on that, but I can show you guys. The only thing that you need, I'll set up a chart for the breakout breakdown strategy. Okay, you need a couple of things. That's indicators. You need the EMA, the 50 and the 200. So if you go to indicators, you do the moving average exponential 2 times. You'll see it happen on the chart. Then this is, you can alter it with inputs and you can make the length 50. The moving average, an exponential moving average, is just the average price of, in case of a 50 EMA, it's the average price of the 50 candles, the last 50 candles. You have a simple moving average, which gives weight equally to all the candles. Then you have the exponential moving average, which gives more weight to the candles, the last candles. So it makes the moving average, it makes the EMA a little more reliable, because it fluctuates with price more. So you have the 50 and you have to put on the 200, make that 200. What you then also can do is you give it another color so you can distinguish them better. So let's say we make the EMA 50 red and we give the EMA 200 a black color. So now you can see we have 50 EMA and the 200 EMA. For anybody who's joining now, let's put in here what I am explaining. So this is the Bob D strategy, breakout and breakdown. So, and also what I use is on this strategy, the RSI, relative strength index, and sometimes I would add the MACD to the moving average. These are trend indicators, so this will tell you something about the trend. But for now, we'll keep it only to the RSI. I will alter that a little bit. So is on. RZ black, a little bit thicker, and all right. So if you set up your chart like this, you can then, what I then do is start looking at trend lines, because a breakout and a breakdown means it breaks out of something or it breaks down of something, and usually that something is a trend line. So the best trend lines, I use wicks for trend lines always, and I want at least 3 points of impact for a trend line to be valid for me. So let's say someone is mic on. So let's say I see a trend line here. It's always easier, of course, in hindsight, but this is also for you guys to explain. So I see we're on the 4 hours. You can use this strategy best at on the 15 minutes, because it's more like a scalping strategy, but I'll do the 1 hour right now. As you can see here, I replay the chart. Let's say this is the chart you are looking at, and you see that there is a lower trend line, and there's also well, not totally, yeah, maybe there was also a higher trend line. This forms a pattern. Usually this triangle pattern just is usually a continuation pattern, but could go either side. So at this point you would be watching for either a breakout above with a retest, or you would be watching a break down from the trend line and a retest. This is also the strategy I use for the 180 trade challenge, because it's a strategy that for me works on the in the long run. So basically that is what you're watching for, and you want to have a break out, so of a breakdown below the trend line when price is moving below the 50 and the 200 EMA, and you want a breakout above the trend line when price moves above. So that's your confluence. So you zoom in, you will see we play the chart. Also, if you use the RSI, you want to see a bearish or a bullish move. So if we break down here, you want to see on the RSI a bearish move too, which means the RSI moves through the moving average. So it moves through the red line. But as you will see, if we play this chart, it will first kind of break down, but doesn't really break down. Then eventually we had that bump a while ago. This was a couple of weeks, was last week. And as you can see, this was just one big candle breaking out. There was no retest, so you could not have entered that unless you were probably watching the 5 minutes. You could see it break out, have a small retest, but eventually you want confirmation. So you never, or what I never do is I never enter on the breakout itself. I want to have at least 3 candles below the trend line. There is an example here, but that it's the 5-minute chart. But as you can see here, what you want to see is a breakdown and a closed confirmation below the trend line, and then a retest. If I took this trade, it would have ended up in a loss, and I would have closed once it closed back above the trend line. But what I wanted to show you, eventually this trend line, I think, moves further. I'm going to delete this, and I'm going to keep this trend line because price comes back down eventually. And we still have this trend line here. And here you see that again you have a breakdown candle, a confirmation candle, but you don't have a retest candle. So if I should tell you when you should enter, it's always if it breaks down, you have to have 3 candles. So I'll have a look at a good let's say I have this trend line here. This is just for example purposes, because this is not a good trend line. But let's say we have a trend line here. You can see a breakout here and a breakout here. So this is first it tried to break out. So this was a fake out candle. You see it has a big wick. It had a big wick above the trend line, and then it closed back down. The second candle after that was a breakout candle. It started below the trend line, and then it moved up and closed above. This candle was for me the confirmation candle, it was fully above the trend line, and then you had a retest. So after the retest, that's the point that you enter. So after the second candle closes above the trend line, you put a trade, or you put a entry on the trend line. And then the question, at what point would you consider the trade invalidated? Once I have a confirmed close below the trend line, so exactly as the confirmation, the second confirmation candle closing above the trend line. If I enter a trade at this area, but then it moves below the trend line and closes here, then I would consider the trade invalidated. It is never a guarantee that a setup will work or that a trade will go exactly as you think it will go, because there's always a possibility of it going the wrong way or the other way. And that's why it's so important that you learn to either cut losses fast or have invalidation points, because usually, especially when we start out trading, we look at profits. We want to see what's our take profit, where should we take profit. But what we forget about is that you should always look at, okay, I have this idea, this is what I'm trading, this is my strategy, has to check these boxes, but when is my trade invalidated? Because you have a stop loss, but stop loss should be your worst case scenario. And personally, I think every trade should have invalidation points before stop loss hits. Stop loss should only be hit in case of tight stop losses when scalping. That can happen, or in case of market dumps or pumps unexpectedly. That's when stop loss just saves your ass. But for every other trade you enter, you have to have invalidation points before your stop loss hits. And when that invalidation point comes, you have to be rigorous, and you just have to cut your trade, even if you're in a loss. Even if you look at the chart and think, well, yeah, I saw this. Let's say you're in a long position, and the trade moves to your invalidation point, but the next candle starts with a bullish move up. You then have to stick to the rules. Then you have to say, well, I have to cut it, because else you will be trading from emotions, and eventually, believe me, that's gonna get you wrecked. Lot overbought and oversold. You can see that on the RSI, and RSI just tells you it's a momentum indicator which tells you the strength of the market. If, let's see, usually they say when the RSI trends above 70, it's considered overbought, and when it's under 30, it's considered oversold. And what overbought means is just that there's a lot of buy pressure, there's a lot of people buying, but that has to come to a climax. But what I don't like about overbought and oversold is that, as you will see eventually in a bull market, prices can be overbought for days, sometimes even weeks, before RSI starts to turn around. I was looking at the Bitcoin chart. I had the weekly drawn out. As you can see here, let's clear this. this is the weekly chart, and on the weekly chart, the RSI was overbought for, let's measure that, just for almost half a year. So you would say at some point it would turn around, but as you can see in bull markets, yeah, prices just stay overbought for a long period. So it means that there is a lot of buyers, and there should be some turning point, or a lot of sellers, and they should get exhausted at some point. But always use that with more confluence on the chart, or with other indicators on the chart. So it could be a good place if you see that price is oversold and sellers get exhausted. It could be a moment where you could say, well, maybe price will rise again. That's also when divergences start to happen, usually in overbought or oversold territory. So you can use it, but use it wisely, and use it only in confluence with other indicators. If you look for a trade, you always look at areas of interest, areas where price might move. So it's not said that price will move there. I think price at one point will move there, but as you can see, if we longed, of course, if I gave the signal here and we longed up, you could have made profit, but sometimes there was no indication, rather than an area of interest above that I like to trade from, that I think price will make a reversal. There wasn't anything on the chart saying to me that, okay, there is a potential long in play here. So that's, I don't think it's a stupid question, because if I think price will move to a certain point, why don't I take the advantage of that knowledge and long it all the way up? But the simple question is I don't know if price will go to this area. I don't know if the price will fill my bids. I just think that if price goes there, I think that's a good way, or a good point for shorting. And vice versa is the same. If I see an opportunity for a long, you let the trade come to you. So we wait until price goes to a certain point, and then we want to see a reaction. So if price moves to, in this case, the 707, where we have our trade bid, our first bid, and the 716, which is the golden pocket and the top of the 4 hour fair value gap, I do want to see a reversal here, like I drawn here. So I think at first we will see a reaction here, but maybe if market's that strong at that moment, it will just go through. So but to keep things simple, you look for points at a chart where you think price will move at some point, but you never know if it can go there. But if you and it goes for shorts and longs, because I think this area below here, the local low, this could be a great area for a long if price gets there, but it doesn't mean it will get there in the short term. So I could enter a short here, but what if it first goes to fill this bits and then goes down? Then I have a huge way to go to get in to a loss before, and I would probably hit my stop loss before we go there. So you see that price doesn't move in one direction. It goes up and it goes down, it goes up and it goes down. So I expect when it comes up here that it goes down again. But that's why we don't trade every move up or every move down, because we want more than one thing telling us that there is a possibility of a reversal or that our trade will play out. Thank you guys for being here. Thank you guys for your questions. I'm going to find my bed. Hopefully have a good night's sleep. And then we go again tomorrow.